As of the close of the market on Friday, May 26, 2026 at 4 p.m. Eastern Time, Micron Technology Inc. is sitting at $767.97 per share, marking a significant intraday gain of 5.87% during the final trading session of the week. This push higher caps off a dramatic period of volatility for the semiconductor giant, outperforming the broader tech indices as trading volume surged late in the day. While most investors are focused heavily on the massive artificial intelligence data center trade, the real catalyst behind this specific 5.87% jump was an unannounced infrastructure expansion in Virginia, where the company began manufacturing its highly advanced 1-alpha DRAM chip at its Manassas facility. This domestic production push directly answers the supply chain anxieties that have haunted the semiconductor sector for years, offering high-security defense and automotive industries an entirely American-sourced memory chip. By expanding local wafer supply, the company has quietly positioned itself as a protected defense asset while the market was busy looking only at graphics card pairing metrics. The general consensus among casual market observers is that memory chip stocks are simply a direct derivative of the broader computing boom, moving completely in tandem with heavyweights like Nvidia stock. When big data infrastructure expands, memory demand rises, and when server building slows down, memory stock prices plummet. Investors often look at platforms like Robinhood, scanning through popular tech stocks, and treat memory manufacturing as a commoditized necessity rather than an independent engine of technological shift. People log on to their retail accounts, execute Robinhood stock trading orders, or check their portfolios via the Robinhood app, assuming that memory is just data storage with very little pricing power. They look at online investing apps, see a surge in chip demand, and pile into individual brokerage accounts believing that the entire thesis begins and ends with standard server expansion. However, the deeper reality is that memory architecture has fundamentally separated itself from historical cyclical patterns. High bandwidth memory is no longer just a basic storage component. It is the physical bottleneck restricting the speed of modern hardware. If you examine the hardware stack, a processing unit can process data at lightning speeds, but if the memory architecture cannot feed data to that processor fast enough, the entire system stalls. This structural bottleneck has shifted the pricing power heavily toward memory producers. While retail traders on platforms like SoFi Invest or basic investing sites focus entirely on processor sales, institutional capital has been aggressively accumulating hardware bottlenecks. This isn't just a standard upcycle in a commodity market, it is a structural re-architecturing of computing infrastructure that places specialized DRAM makers at the absolute center of global production control. Looking directly at the latest market activity, the trading volume for the stock has shown massive institutional accumulation during recent weekly swings. Major investment pools managed through institutional platforms like Interactive Brokers have redirected capital away from standard hardware towards specialized domestic infrastructure assets. When analyzing the Interactive Brokers platform data, the order flow reveals a steady stream of block trades occurring at the closing bell, signaling that large asset managers are positioning themselves for a long-term supply crunch. Sector momentum has been highly favorable, yet volatile, driven by macroeconomic pressures like high interest rates and global shipping constraints. Every time a manufacturing delay occurs in overseas fabrication plants, domestic players experience an influx of safety-seeking capital. Institutional buyers utilizing high-tier platforms like Interactive Broker stock trading tools are focusing heavily on the fact that domestic fabrication reduces geopolitical risks, making it an attractive play for sovereign wealth funds and defensive portfolios. This institutional momentum is also highly evident in the major exchange-traded funds and mutual funds that populate modern retirement accounts. For individuals who prefer self-investing or manage their retirement through accounts like Fidelity IRAs, this stock has become a top-tier holding within major sector portfolios. Inside the Fidelity trading platform, users analyzing Fidelity investments can see that the firm's major diversified products hold massive blocks of memory hardware companies. Whether you look at classic tracking funds, specific Fidelity ETFs, or actively managed Fidelity mutual funds, the presence of specialized storage manufacturers has expanded significantly over the past year. Large asset managers who handle massive allocations through systems like Fidelity Wealth Management understand that the underlying value of tech infrastructure is fundamentally tied to memory capabilities. Even retail participants tracking their assets via the Fidelity mobile app have witnessed these industrial holdings outpace traditional consumer software companies in sheer asset weight. To truly understand how this business operates, we have to examine its core business model. The company operates primarily through four major distinct segments: the compute and networking business unit, the mobile business unit, the storage business unit, and the embedded business unit. At its heart, the firm designs and builds three primary technologies: dynamic random access memory, non-volatile NAND flash memory, and NOR flash memory. Dynamic random access memory provides high-speed, low-latency data retrieval that lets systems run programs smoothly, while flash memory acts as the permanent data storage structure for everything from smartphones to enterprise servers. Historically, this has been a deeply cyclical business model. Memory companies would build massive fabrication plants, supply would eventually outpace demand, chip prices would crash, and the company would face massive profit compression due to its high fixed cost base. Older earnings reports from past decades show these massive swings, where years of spectacular profitability were immediately followed by severe multi-billion-dollar downturns as memory pricing fluctuated wildly based on consumer PC and smartphone demand. Comment below how many shares of Micron Technology Inc. you currently hold in your portfolio right now, and let me know if you are buying more at these current prices or waiting for a pullback. The structural tension in the stock today lies squarely between the expectation of historical cyclicality and the reality of specialized hardware shortages. Traditional financial analysts looking at standard data sheets often warn that memory is an inherently unstable investment because of those historical boom and bust cycles. They point out that when memory markets enter a down cycle, firms with massive physical factories face underutilization charges that destroy net income margins. But this view entirely misses the structural shift toward high bandwidth memory architectures. Modern systems require components that are highly integrated, requiring proprietary packaging techniques that cannot be easily replicated by low-cost competitors. This structural reality has created a distinct moat for the top global memory producers, insulating them from the commoditized price wars of the past. Retail investors using basic platforms like Robinhood Crypto or simple Robinhood cash management accounts might miss these industrial shifts, but advanced traders executing orders through interactive brokers' fee schedules are fully aware that high-bandwidth memory production capacity is entirely booked out for the next several quarters. This shifts our view completely toward the future outlook and the potential catalyst that could drive the next major movement in the stock. There are two primary scenarios that investors need to watch closely over the coming months. The first scenario is a continuation of intense domestic capacity building. The company's massive $200 billion long-term U.S. investment strategy, which includes expanding campuses in Idaho and building new memory manufacturing complexes in New York, positions it perfectly to capture massive federal and state incentives designed to secure domestic technology production. If these facilities come online on schedule, with the first Idaho output expected around mid-2027, the company will solidify its position as the ultimate domestic source for critical computing components. This provides an incredible buffer against international trade disputes or supply chain disruptions that could cripple foreign competitors. Investors utilizing active trading sites, whether through SoFi active investing options or specialized online investment platforms, must view these massive domestic infrastructure investments as long-term equity security. The alternative scenario involves the clear risks associated with such aggressive infrastructure spending. Building advanced semiconductor fabrication plants require astronomical capital expenditures. If global demand for enterprise computing solutions experiences a sudden, unexpected macro-driven slowdown before these massive multi-billion-dollar facilities achieve full production efficiency, the company could be left holding massive overhead costs. This structural overhead could severely depress margins and trigger the exact cyclical downturn that traditional bears are constantly predicting. Furthermore, competing international manufacturers in South Korea and Taiwan are also expanding their advanced manufacturing capabilities aggressively. If global capacity surges across the entire sector simultaneously, we could see a return of structural oversupply, driving down chip prices and hurting the stock's valuation. When searching for investment help or analyzing individual asset allocations through a SoFi robo-advisor, balancing these high-reward infrastructure expansions against the risk of capital overextension is the key to managing risk. When we look across the entire landscape of modern online investing, the contrast between investor expectation and industrial reality remains the most reliable indicator of asset mispricing. The market narrative expects this chipmaker to behave exactly like a volatile old-school component supplier that rises and falls entirely at the whim of the broader tech sector's purchasing managers. The industrial reality shows a highly strategic, deeply entrenched domestic manufacturing powerhouse that is fundamentally reshaping how modern high-speed data architecture functions. By locking down multi-billion-dollar domestic facilities, securing critical supply contracts with aerospace and defense sectors, and commanding unmatched pricing power in high-performance memory configurations, the company has broken away from its historical commodity identity. Whether you are tracking the stock through specialized instruments like Fidelity ETFs, managing a portfolio on the SoFi trading platform, or buying Robinhood fractional shares, understanding this structural evolution is essential. The market will eventually adjust its expectations to match this reality, and when it does, the premium placed on domestic technology infrastructure will likely redefine the valuation of the entire memory sector. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.